Right, it's recording, right. So first thing I need you to do in regards to fiscal policy is obviously define what fiscal policy is, who's responsible for it. Yeah, so see if you can do that. Obviously in regards to fiscal policy, okay, so what I always remember about fiscal policy is G and T, okay? G and T, not gin and tonic, government spending and taxation, and that is done in the UK by the Chancellor of the Exchequer, who, as you know, has been a bit difficult this week in regards to taxes himself, but that's the person responsible for the budget that happens every year, where they set tax levels and allocate money to the different departments within government. Okay, so that's in a nutshell what fiscal policy is. So you need to know the largest areas of government spending and taxation. So biggest area of government spending, 1, 2, 3, and the biggest areas of taxes. See if you can identify them things, please. Get that done. Okay, so biggest areas of government spending. Hopefully you can remember. Number 1 is on social protection. Okay, social protection, that's on things like the housing benefits, child benefit, universal credit. Okay, so that's things that are included in pensions and social protection. Number 2 is healthcare, so health spending. That's obviously on things like the NHS. And number 3 is education. Okay, so they're the 3 largest areas of government spending. Taxes, biggest receipt the government have from taxes is income tax. Number 2 is NIC, national insurance contributions. Number 3 is has left me. It's either VAT or corporation tax. Think of that. Need to double check that, obviously. Right, so anyway, largest areas, there they are. Obviously, there was a spring statement not so long ago, so it might be a good idea to double check them. But in the over time average, most spending comes or goes on social protection, health, and education, and predominantly most of the income comes from income tax and national insurance contributions. Okay, so that is G and T in a nutshell. I have a scenario for you. Okay, so the economy is in a recession. Okay, they're in a recession. What type of fiscal policy does the government implement, please? So hopefully you've got what we call expansionary. Okay, expansionary fiscal policy. Okay, and this was advocated, created, might be a bit of a stretch, by Keynes. Okay, so this is very Keynesian theory. And expansionary fiscal policy is whenever you increase government spending and reduce taxes in order to boost a day. Okay. So if you think about the Great Depression in the 1920s and 30s in America, this was the big thing. Okay, so they built things like the Hoover Dam, they built massive infrastructure, railways, etc., in order to boost jobs, boost the money in the economy, and get employment and the economy going again. Okay, and you can also decrease taxes. Okay, so obviously if you reduce taxes, people have more money to spend. However, the idea, or a quick AO4 point for that, is it depends upon people's marginal propensity to withdraw, specifically save. Okay, because if they're in a recession and people are not, very confident about the economy, they're not very confident about the job security, they're obviously going to save, even if they have more money to spend from lower taxes, have higher disposable income, they might actually spend the same amount because they save more of it. Because of uncertainty, etc., which doesn't actually boost AD. Okay, So that's what it looks like. See if you can draw a diagram to show that, please. So it might be a good idea if you are doing expansionary fiscal policy, to do Keynesian LRS. Okay, so obviously at LRS, there is full employment. And if you're in a recession, AD is going to be very low. Down here at P star, maybe Y star. Okay, so obviously if expansionary fiscal policy is used, you would boost GDP. Okay, good thing about this is that there is no inflationary pressure whenever GDP is very low. Okay, because there is a lot of what we call, in both these cases, slack. Okay, there's a lot of slack, or what you can call spare capacity in the economy. Because there's a lot of because there's a lot of slack in the economy, there is more. There's quite a bit of spare capacity. There's no upward pressure on prices. It's not like workers have to work overtime. It's not like resources are being stretched. It's not like we're running out of room. Okay, which you'd expect to occur here. Okay, this would be very low slack. And if you look up then what was happening here, then obviously we're getting close to spare or full capacity. Okay, so at 82, there's a lot more pressure on prices. Okay, because there's less slack and spare capacity in the economy. Okay, so I suppose you could say a bit of a couple of AO4 points is the first one could be about people's marginal propensity to save. If it's quite high, there will not be the boost in AD that the government maybe wanted. Another AO4 point might be the idea of a paradox of thrift. Okay, another AO4 would be paradox of thrift, and this is the idea that in a recession people should spend more money. Okay, so consumption should increase, they should help themselves, but in fact what people tend to do in a recession is the opposite. Okay, they spend actually less. What that does is that drives down AD even more, which makes the situation worse. Okay, so thrift, think of being thrifty, cautious with money, which is a big, you could apply that to the marginal propensity to save point as well. And another one might be the idea of the multiplier effect, okay, which again, they all link together. So the multiplier might be quite small, and there might not be that boost in AD and GDP that you maybe thought first off. Okay, so that's expansionary. Fiscal policy. So see if you can do the same for contractionary. So when's contractionary fiscal policy used? What is it? And see if you can perhaps think of a few critiques of such a policy. Okay, so obviously we're talking about a boom phase, okay, or what's maybe called a positive output gap, and that's whenever you would use contraction fiscal policy. Okay, that is whenever government spending goes down and taxes go up, and that is in the pursuit of overall AD being reduced, contracting AD. Okay, ultimately reducing GDP in the economy. Okay, because it might be too high, etc. Obviously, in a boom phase, okay, if you think about the classical, the Keynesian LRS, AD might be at AD1 here. Okay, so we're at P1 and Y1. There's FE there. There's LRS. You can do these properly. The axes. Okay, if you're talking about contractionary fiscal policy, you'd be looking to reduce inflation. I was supposed to come up with a different colour, but it didn't. Reduce inflationary levels. Arrows or Keyn diagrams, okay, like this. So Y2, P2. If the examiner sees what you're saying, so you go from this equilibrium to this macroeconomic equilibrium. And the reason was at Y1 and P1, inflation was too high. You're in a boom phase. Okay, the government had to step in and use contractionary fiscal policy. So that was things like increase in taxes. So increase in income tax, so people have less disposable income and they spend less, which reduces AD as a negative multiplier effect kicks in, or same for government spending. So less spending on G, component of AD, reduces GDP. Okay, so that's obviously that. Some AO4 for contractionary fiscal policy is it's hard to fine tune the economy. Okay, so this could be these all kind of link. So this is the idea of fine tuning, is the idea that you want to pursue very specific changes and results in the economy. And that's obviously very hard to achieve. Okay, so it's all right saying, oh, let's use contractionary fiscal policy to achieve lower inflation, but the knock-on effect of that ultimately could be that you, in fact, overshoot your intentions, and people maybe, really take the lower government spending and higher taxes sort of personally to a certain extent, and they're very fearful about the future, and obviously then that can cause a recession if you get it wrong. Okay, so they can have that damaging effect upon the economy, and obviously as well in regards to fine tuning, it could get worse and actually cause deflation, and you should know the repercussions of deflation by now. Okay, so that is fiscal policy, that is expansionary and contractionary. Quick one then. So what's the three types of budgets that can be operated? So budgets are announcements by the Chancellor of the Exchequer in regards to G&T. There's three types, 1, 2, and 3. Okay, hopefully you've done this quite easy. A budget where they are spending more than they bring in from taxes is called a budget deficit. Okay, budget deficit. Think budget deficit as a negative. Okay, if they are spending more than they bring in from taxes, they're obviously going to have to borrow money. And if you borrow money, that's obviously a negative thing. If you operate a situation where government spending is less than taxes, or tax income is greater than government spending, that is called a budget surplus. Obviously, we operate deficits more in the UK recently. Okay, there's only been 4, I think, budget surpluses in the past 60 years. We tend to spend more than we bring in from taxes, which obviously is deficit negative. So if you bring in more from taxes than you spend, that's called a budget surplus. Another one, which happens rarely, is when G equals T, and that is called a balanced budget. Okay, so a balanced budget was the aim at the end of what was called austerity. Okay, as you know, austerity was introduced in the 90s, and it was with the pursuit of getting rid of this. Okay, so getting rid of this deficit. Okay, and trying to achieve this. Okay, so obviously if the deficit started off at say 100 billion, okay, the next year they would use contractionary fiscal policy, which is what austerity is, to try and reduce it to say 50 million or 50 billion, and then the next year 25 billion, and then next year 20, and they would work it right up to a balanced budget, and then hopefully one day operate a surplus. And if they had a surplus with this money positive, they could obviously start repaying the debt. Okay, and that's the situation that we are in the UK. We've got quite a lot of debt. So that would be the aim of austerity, and that's how all the budgets could link. So that's that. 2 things I want you to try and define in regards to budgets again. See if you can tell me what in regards to fiscal policy, tell me what discretionary fiscal policy, tell me what discretionary fiscal policy is and what automatic stabilizers are. And there's brownie points if you can tell me the famous quote that goes with automatic stabilisers. Okay, so discretionary fiscal policy is sort of one-off explicit changes. Okay, to fiscal policy. So one-off. Okay, so that's just explicit. Okay, discretionary. If the government feel that they want to spend more on roads, they'll spend more on roads. If they want to spend more on education, they spend more on education. That's discretionary. That's one-off changes. That's just sort of at the government's discretion how they want to spend. Obviously, different political parties have different priorities. So that's something that happens whenever new governments are elected. Automatic stabilisers are, as the name automatic, these are automatic changes. They are changes to fiscal policy in line, okay, in line with the economic cycle. Okay, they change in line, they actually change themselves, they go up and down in line with the economic cycle. And obviously the famous quote here is fiscal policy can help cushion the fall. Okay, cushion fall. And what we mean by that, if you can draw it maybe now, is the automatic stabilizer diagram. Okay, so see if you can draw that now. So the automatic stabilizer diagram is basically an economic cycle. So GDP and time. Okay, and you've got fiscal policy without, sorry, not fiscal policy, GDP without fiscal policy. So sort of like a free market. Okay, and then you have got fiscal policy being in place. Okay, and you can see that it's more controlled. Okay, the peaks aren't as high, the troughs aren't as low. So this is GDP with fiscal policy. Okay, so as I say, whenever the economy is going really high and you've got massive peaks, they're controlled. Okay, so they're sort of reduced. And whenever there is fears of massive downturns, okay, they're not as low. It's controlled. Okay, so this idea is that fiscal policy can help cushion the fall. It's an automatic stabilizer. Okay, so that's what fiscal policy can do. And how it does this, is another little diagram. Okay, so this is on the y-axis, your government spending and taxes, and on the x-axis you've got GDP. Okay, and basically you've got a scenario where, give me 2 seconds to draw this, please. Looks a bit messy, but it's quite straightforward. So basically, whenever, different colour here. So whenever there is possibly a recession going on, okay, so at Y1, okay, you can see that here would be the level of taxes. Taxes would be low. So taxes would be low and government spending would be high. And that's obviously a budget deficit. Okay, and that could automatically happen. That's what you assume would happen. Okay, in a deficit. Okay, so instead of the economy being really low and out of control, automatically through the use of fiscal policy, just from being in place, government spending will be high because obviously there's a benefit system in the UK, there's a health system in the UK, there's an education system in the UK. So that will help boost the people's incomes and people's life possibilities whenever the economy is not doing very well. and also tax levels will be lower. So income tax there won't be as much generated from income tax, because obviously, if you think about it, people out of work, unemployment tends to be very, very high in a recession. So if more people are out of work, they're making less money, so therefore income tax receipts falls, and VAT receipts fall. So that's what you would call, obviously, a budget deficit, which automatically happens. Okay. And then obviously, if you go to the flip side of it, so you go over here, you can see that whenever the economy is doing really well at Y3, government spending is low, taxes is very high, because of the opposite, okay? Tax receipts are going up, government spending is low. That's obviously what you would call a budget surplus, okay? And if you think about how it controls the economy, instead of a peak being really, really high, okay, whenever people's incomes rise, okay, they pay more taxes, and that controls their spending, and that brings the economy sort of in check, okay? So that's one of the ways that fiscal policy automatically controls the peaks within the economic cycle, and obviously government spending will go down and cause this surplus, because more people will be in work, more people will go from universal credit into paid employment, which is less money spent by the government, etc. Okay, so that is fiscal policy there. Okay, so yeah, we've done AO4 for fiscal policy. Hopefully you understand it a bit more now. Let's have a look quickly at monetary policy. So see if you can define monetary policy. Think of a few things about it. Okay, monetary policy is obviously, I always remember my X. Okay, my or mix, I suppose. Mix would probably go better. Okay, mix. Too many X's in economics. C of X's, we don't need another X. So let's go mix. Obviously, that is the use of controlling the money supply via quantitative easing, using interest rates, and not done in the UK, but is part of monetary policy, is the exchange rate. Okay, so we're going to focus primarily in the UK, okay, on these two, okay, but you have to be aware that this one exists as well. Okay, I'm going to leave that to another lesson, okay, exchange rates, but let's have a look at monetary policy. So most of this is much the same as fiscal policy, because fiscal policy and monetary policy okay, monetary policy and fiscal policy are both what you call demand side policies. Okay, they both impact the demand side AD within the economy. Okay, so obviously fiscal policy affects specifically consumption, investment, and government spending through taxes and government spending. Monetary policy won't affect government spending as much, it still will have an impact, but it predominantly will affect consumption and investment by businesses. Okay, so the same thing applies. I'm just going to split the board in half. So see if you can identify what expansionary fiscal or monetary policy is on one side, what contractionary monetary policy is on the other side, what it does, and some AO4. Now, the AO4 obviously will be very similar to fiscal policy for some of it in regards to what happens in the economy, but I have a think specifically to monetary policy. Okay, so hopefully you have got that expansionary monetary policy. Okay, expansionary monetary policy is whenever, if we just focus on the M and the I, okay, so when the money supply is increased and interest rates are reduced. Okay, it might be a good idea now to define interest rates. So hopefully you've got the interest rates are the cost of borrowing. Okay, so this is a good one to know. So interest rates are the cost of borrowing and the reward to saving. Okay, so that's kind of key in all this. It's probably one of the bigger or the more orthodox approaches to monetary policy using interest rates. So if interest rates go down, that means that the reward to saving is less. People aren't as incentivized to save the money, and borrowing is cheaper. So people are incentivized to take out loans, mortgages. Businesses are, take advantage of lower interest rates as well and invest more in regards to buying capital equipment, etc., and expanding the business. And they can also use an increase in the money supply, which is the use of quantitative easing. Okay, so we'll talk a bit more about that in a second. So that's expansion monetary policy. Obviously, that has got the aim, okay, of boosting AD. Okay, so just like fiscal policy, okay, you would use expansionary fiscal policy if the economy was in a recession, okay, and obviously, if the economy is in a recession, boosting AD is what you want to do. It's a Keynesian theory. You can use monetary policy as well, and that should boost GDP and improve things in the economy. The diagram is the exact same, okay, so this is quite handy. Obviously, that's the main advantage if it works, but there are some critiques of expansionary monetary policy. So obviously you had, like before, you had a situation where it might be recessionary. No, so this is expansion one from it. It could be inflationary, it could cause too much inflation. You had a situation, it's hard to fine tune, you could overshoot. Yeah, so it depends upon people actually taking the loans out, etc. So the availability of credit is something that can be discussed. It's already saying interest rates are lower, but if banks don't want to lend out money, that's a bit of a tricky wicket. And in regards to that as well, there is sort of like a lower bound to interest rates, okay, in the sense that they can't go lower than 0% in the commercial markets. That's a bit of a tricky one because obviously, the actual official rate during the pandemic was from the Bank of England, the base rate was 0.1%. So obviously they couldn't lower that because obviously you can't have a situation where you reverse what's going on down here. Okay, banks would never, they're profit-making organizations, they would never, cost saving, like charge people to save or reward people to borrow. Okay, that won't happen. That's what central banks can implement to commercial banks to incentivize them to lend out more money and stop saving in the bank, but it would never happen in the commercial bank. So the situation where there's a lower bound of 0% is unfortunate because if it's already low, you can't lower it any further, which is one of the biggest negatives. And also there is a liquidity trap you can also discuss. Okay, and that is basically whenever lower interest rates do not result in a boost in the demand for money and AD going up. Okay, so that's another critique of expansionary monetary policy. Okay, you can obviously go away and research more there, and you can obviously think about the same ones we had for fiscal policy. Contractionary monetary policy, again, just before I do contractionary monetary policy, I kind of forgot to mention that all this is done by, okay, both of these are done by the Monetary Policy Committee. Okay, so both of the, So I'll call it clear now. The MPC do both of these, okay? So they meet once a month. Their current governor of the Bank of England is Andrew Bailey, and they meet once a month to decide what to do with interest rates predominantly, and they can also announce things to do with quantitative easing as well. So that's the people that are responsible for monetary policy. So the monetary policy committee of the Bank of England. Okay, but then a contractionary monetary policy is whenever the money supply is reduced by reversing quantitative easing and interest rates are put up. Okay, and the pursuit of this is obviously to reduce AD and GDP and predominantly inflation in the UK. So in regards to the MPC, like I said here a minute ago, their main aim by the government is to keep inflation in check at 2%. Obviously as well, they do need to keep an eye on things like unemployment and GDP, but their sole target by the government was to control CPI inflation at 2%. So whenever we're saying both of these, so we're saying reduce AD, that's ultimately to reduce inflation. And whenever we're talking about things like boosting AD, okay, we're obviously talking about reflating the economy, so boosting inflation if it's below the target. Okay, so if the target is lower than 2%, plus minus 1%, so say it's at 0.5%, they would use expansionary monetary policy to boost inflation and get it back up to target. And if they had a situation where it was too high at the minute, so say over the 6% mark, they would use contractionary to bring it back down to 2%. Which is a trick. And then on that, okay, for both of these actually, another big area of 4 point, it depends upon the underlying cause of the inflation, okay? It's all right saying you'd use contractionary monetary policy to reduce inflation, but if it's cost push factors, okay, which is kind of what's happening in the UK in regards to things like components for cars and computers, in regards to oil prices, in regards to supply shortages, skill shortages, they're cost push factors that are causing high inflation. So actually using the contractionary monetary policy, which is a demand side function, won't actually be that good, and it might just cripple the economy in regards to people spending, etc. So that's a big one for contractionary. It depends upon the cause. Okay, cost push won't actually be helped that much. And then obviously, as I say, you can use any of the other things we discussed earlier on. Okay, so something you don't need to know inside out, but it's a good idea to understand the difference and the relationship between changes in interest rates and changes in inflation. Okay, so how these two things result in one another. So whenever interest rates are lowered, how does inflation go up? And how whenever interest rates go up, inflation goes down, is a thing called the transmission mechanism. Okay, so see if you can recall the transmission mechanism. I'm going to outline it here. Okay, so something here goes on to affect 1. They're supposed to be squares. 2, 3, 4 things. These 3 go on to affect 2 things. These things go on to affect 1 thing. That goes on to affect something. This one goes on to affect 1 thing, which goes on to affect 1 thing. Right, so basically that's a really bad effort at drawing the transmission mechanism. But basically, in a nutshell, you've got the Bank of England base interest rate, okay? And at the other end, you've got inflation, okay? Okay, and this is basically how, if the Bank of England decide to increase interest rates, for example, okay? So if they increase interest rates, why will inflation go down? This is to help you do your logical chain of reasoning, develop analysis, okay? So basically, if the Bank of England reduce interest rates, there's a process that this feeds through. So it goes on to affect what we call the commercial rates in the UK. Okay, so they're like the high street banks. it goes on to affect asset prices. It goes on to affect confidence. And it goes on to affect the exchange rate. I'll finish the exchange rate off in a minute, but these first three go on to affect net external demand. They affect internal demand. That will obviously both go on to affect inflationary pressures within the economy, and that should result in changes in inflation itself. Okay, so if we finish this one off, then if the Bank of England put up their interest rates, that will be built into a lot of mortgages. It'll be built into a lot of long-term loans that banks implement for their own safety. So they will put up their rates as well. Asset prices in the economy. If interest rates are higher, okay, that means the cost of borrowing is more expensive. So people will not be looking to take out mortgages to buy houses. So the demand for houses will fall. It may also mean that businesses will be less likely to invest, expand, grow, which isn't good for things like the share price, okay, and confidence in them. So asset prices throughout the economy should maybe fall. Confidence will be lowered as a contractionary policy. And if we go through, then external demand. If asset prices are falling, there'll be less demand from outside the UK. Internal demand, because it is a contractionary policy with the lower confidence, will mean there's less spending within the economy. That will drive down inflationary pressures, and if we say, as we said at the start, that should result in, from the higher interest rate, lower inflation at the end. Okay, so that's the transmission mechanism there. The exchange rate, okay, there's a process. If the base rate goes up, that means that the exchange rate should appreciate. Okay, does anyone remember what that's called? See if you can pause the video, see if you remember what it's called. It's called hot money flows. This is, you have to get this in your head, right? If the interest rate in the UK goes up, okay, if the interest rate in the UK goes up, that means that the exchange rate will appreciate because the return in the UK is higher, okay, on your savings or your money. So people will look to move their funds there, ceteris paribus, okay, if that return is greater than other countries. So if interest rates go up, people move their money into the UK, that increases the demand for the currency, which causes an appreciation in it, okay? So that has to be sorted. If that happens, the next part of the diagram was import prices. Okay, import prices and prices. And if the exchange rate is higher, obviously you always remember spicing. Okay, so that means that imports become cheaper. So they go down, and that means if our import prices are cheaper, that means there will be less inflationary pressure within the economy. Okay, so that's that. And then obviously, if you reverse all these things, okay, so if the Bank of England decide now actually they need to increase inflation because it's below the target, okay, so in order to boost inflation because it's below the target, they will obviously have to do the opposite. They will reduce, they will reduce the interest rate. They reduce the base rate, all the opposite happens everything. Okay, so the commercial rates will go down, asset prices will go up because it's cheaper to borrow money, demand goes up, confidence would improve because it's an expansionary policy, exchange rate will depreciate, that leads to WEDEC, which means imports become dear, which means that goes up. We know then that obviously will feed through to higher inflation within the UK. Go back up here, net external demand will go up because asset prices and share prices in the UK are going up. Internal demand will go up because there's more confidence and expectations within the economy. That will cause higher inflationary pressure, which should result in the inflation target going up. Okay, so that is that. And I think that is nearly everything for monetary policy. Last thing, however, obviously is quantitative easing. Okay, so see if you can remember the stages of quantitative easing there. Okay, so let's go through the QE processes. So the first thing is that the Bank of England electronically create money, okay? Okay, so they electronically create money. You don't need to much more about it than that. So what they do with that then is they buy from financial institutions what are called government bonds, okay? Predominantly government bonds, okay? And these are from private financial firms, okay? Who have got these government bonds which they can sell, okay? So obviously, if the government buy these government bonds, okay, that means these banks have got more money, okay? So in a nutshell, okay, what you have to remember is these financial firms have increased in the amount of money they have, okay, in their banks. A side note, the key thing happens is the price of government bonds, okay, the price of government bonds will go up because there's more demand for them. So government bonds, like any price, will increase in price, okay? And if they increase in price, the return on them, okay, this is kind of key, okay, the return on them, the yield of them, or the return on them, will go down. There's an inverse relationship between the price of a bond and its yield, okay? And the yield, that was called a coupon, okay, tends to be fixed in its price, okay? So say, let's just do an example here, right? So say, in a very basic example, the coupon for a government bond that was, say, at the time, £10 was, the coupon was £1, okay? So the return was £1, which is a 10% interest on the £10, okay? What happens then, but is, as more of these are bought, the price of the bonds goes up, okay? So say the price of the bond goes up to £20 because more are bought, okay? The rate of return is still £1. So obviously, whenever it was £10, the rate of return, the yield was 10%. But now, the rate of return from £20 is only 5%, okay? So what happens then is yields go down, the return from the coupon, and that causes interest rates throughout the economy to go down. Other financial and commercial interest rates start going down. And that, hopefully, should boost AD, okay, within the economy, because lower interest rates means banks obviously lend out more money because people want it more, and that should boost consumption. The reason I wrote in that financial firms increase their money supply as well is, obviously as well, they don't want to just hold on to that money, okay, that they have from the government. So obviously they'll look to, invest that in companies, in corporate bonds, in securities as well. So obviously that's another way, okay, that businesses, financial firms that get the money help through the process of quantitative easing to boost AD. You do need to know the opposite, the reverse, so it just all basically reverses. The money isn't created, but what the government do then, in opposite land, is they sell the government bonds back, and all the opposite should happen as well, okay? So we'll spend a bit of time maybe looking at that, because I'm conscious of the time here now, so I wanted to do supply side policies again very quickly. So there's not much to supply side policies. See if you can define supply side policies, talk about the two categories of supply side policies, and draw a diagram showing a successful supply side policy, please. Okay, so supply side policies aim to increase the productive potential of the economy over a specific period of time. Okay, so they look to boost. Okay, basically they look to increase the LRAS. Okay, two specific categories of supply side policies are interventionist. Okay, interventionist basically are policies that incorporate an increase in government spending. So that's more spending on education, more spending on healthcare, more spending on infrastructure. Okay, they are interventionist supply side policies. But you've also got market-led. Okay, so these are like laissez-faire, free market. Okay, supply side policies, and they would include things like they would include things like stepping back from the economy, like deregulation, okay, privatization. You've got reducing trade union power, and you might also have reducing national minimum wage, bit extreme example there as well. Okay, so they're market-led. They also improve the ability for markets to work more efficiently. Okay, so there are the two categories. Obviously, supply side policy, okay, boosts the LRAS. You've got price level, you've got GDP, LRAS, LRAS1, quite straightforward. P1, P2, FE, FE1, successful supply side policies boost GDP. So in regards to MEPOs, they're very successful. They boost GDP, they create more employment, they lower the price level. That obviously lower price level should boost exports. The increase in productivity from this might improve exports as well, which brings a balance of payments stability. So in regards to that, it's good for the government. However, what you have to remember is the big no-nos, AO4, for supply side policies. The three big no-nos are there's a massive opportunity cost with interventionist supply side policies. They're very expensive. That money could be used on other things. On that as well, their effectiveness is very hard to gauge because they take a long time. Okay. Which is actually the other one as well. Okay, so they take a long time for the process to be implemented and felt within the economy. Think of HS2, it's taken a long time. The effect from different policies is very hard to monitor and gauge as well. Okay, so that is that for supply side policies. So yeah, so basically rewatch the video again there if you want, and yeah, try answering them questions.